Hello and welcome to Ask Me for a Trend. I'm Josh Lipton, and for the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. It's a mixed day on Wall Street today after weaker jobs data and continued concerns over trade tensions. Treasury yields sliding as well. The Dow Jones ended in the red. The S&P 500, the Nasdaq eking out the day up. More Americans may be deferring the dream of owning a home. Mortgage applications down. We're taking a deep dive into where the housing market stands. And the music industry may not be hitting the right note when it comes to compensating artists. The new world of AI is raising important business questions about compensation and credit. We'll unpack what it all means and what's at stake. Well, mortgage demand sliding for a third straight week. Total mortgage application volume falling 3.9% last week compared with the previous week. That's according to the Mortgage Bankers Association. The move lower comes as mortgage rates stay elevated near that 7% threshold. For more on the housing market forecast, let's get to Wedbush Securities Managing Director. That would be Jay McCanless. Jay, it's always good to see you on the show. So as a longtime student, Jay, of this housing market, if I started kind of high level with you and get your take on this housing market, Jay, would it be different, Jay, than 3 months ago or 6 months ago? I mean, what has changed?
Thanks for having me on. I think what's changed so far is probably, whether it's the tariff headlines, some of the consumer confidence issue that Toll called out in their earnings call a couple weeks ago. It just feels like the consumer, especially that entry-level consumer, may be a little uneasy about going out and buying a home right now, even though mortgage rates have been pretty steady around 7%. So I'd say that's one thing that's changed. I think another one is that, and we called this out in our industry piece on Monday, is that the inventory of new homes for sale has been rising pretty steadily, but now that seems to have turned and is coming back down. But on the existing home side, there's still a lot of product out there, and we're seeing that actually grow. So that's home builders' biggest competition is existing homes for sale. And so I think that's a competitive dynamic that we weren't seeing 3 or 6 months ago.
Let's take, Jay, a little bit more into this issue of affordability, too, because I'm just looking here, Jay, that 30-year fixed per Mortgage News Daily is still 6.87%. I mean, how much of a headwind does that remain, Jay, for this market? And where do you see that headed from here, Jay? Where do you think that is 6 months from now or 12 months from now?
Yeah, it's definitely a headwind. If you think about where the home builders have been buying down mortgage rates, they still tell us that 5.5 to 5 3/4 on the 30-year mortgage rate is where the sweet spot is for the American consumer right now. So, we're a good 130, 150 basis points above that. That's definitely an affordability headwind, and it's a gross margin headwind for the builders. That's one of the key questions we have for the group right now is when gross margins are going to bottom out and potentially start to move higher. But if we don't get some help on the rate front, hard to tell where that is. In terms of the mortgage rate call, we came into 25 expecting mortgage rates to be down a little bit. Hasn't really worked out like we expected it, but maybe if we do get a Fed rate cut later this year, like we've seen talking about in the news today, maybe that helps out. We thought it was going to help last year when there were some 3 or 4 rate cuts ahead of the presidential election, and mortgage rates actually went the opposite way. So it's not a guarantee that if the Fed cuts, mortgage rates are going to move lower, but certainly the possibility is out there.
How would you generally characterize, Jay, the spring selling season this year?
Pretty lackluster. I think that's the way to describe it. Whether it was some of the weather headwinds we had in the South in February, snow in Florida, et cetera, that got things off to a slow start. And then mortgage rates were actually helpful for most of the calendar first quarter. But then I think the mortgage rate volatility that we've seen from April 1st until today, that has not helped. And then again, we keep an eye on jobs because the math is pretty simple. If you don't have a job, you can't buy a home. So we're keeping an eye on things like the ADP, where those numbers have been coming down a little bit. Still positive job growth, but we'll see what the big employment print says tomorrow. But those are the things we're watching right now. It's just the jobs and also just some of the mortgage rate volatility coming back into play. Those are the things I think that have made the spring selling season a little below average.
So Jay, we've laid out the challenges for the industry, but that doesn't mean there's not some potential opportunities for investors listening right now. So let's give some people some ideas, some picks. Toll Brothers, you tell your clients, say that is a buy. How come?
Had a very good earnings beat in the last quarter. They also call it 70% of their homes are sold to people who are either active adult, move up, or luxury buyers. Those buyers aren't totally rate insensitive, but they are bringing equity from the sale of their previous home, which helps them with the payment side of it. I also think that Toll has done a good job of buying back stock, of trying to even with the stock coming in this year, being consistent around that stock buyback and returning some money to shareholders.
And how about Beazer Homes, Jay? One other one. That's another buy?
Another buy. That one's a little different story. Beazer is in the middle of a product changeover from being more of a pure entry-level builder to maybe being more of a first move-up builder. They've changed the product out in the field, and now it's going out, getting the home sold, showing the value of the extra things they put into the home. A lot of energy saving, not only appliances, but also the insulation, siding, the different things they're doing to the homes to make them much more energy efficient than they were before. That one, in our view, is very inexpensive at this point. Would take a look at that too.
Jay, always appreciate your time and those picks, sir. Thank you.
Yep, thank you.
With the Dow closing low, we're snapping a 4-day win streak as Treasury yields also sink after weak ADP jobs data. Josh Schaefer joining us now with the trading day takeaways. Josh.
Hey, Josh. Yeah, I want to start with that weak economic data. I feel like that was the main story of the day, in a day where the indexes really didn't go anywhere, right? So we started 8:30 this morning. We get fresh data from ADP, and it shows that private payrolls grew by their lowest monthly number in over 2 years, Josh. So 37,000 jobs added in the private sector. ADP chief economist Neil Richardson told me this morning the key to this print was a hesitancy to hire that they're seeing right now from private companies, essentially saying, with all the uncertainty out there, you have weak consumer sentiment, you of course have trade war uncertainty, just weighing on firms and saying, you know what, maybe I just won't do anything right now. I'm going to sort of press pause, if you will. Another area of the economy where we saw pause this morning. This is from the ISM Institute for Supply Management Services PMI. Entering contraction territory below 50 for only the fourth time. You can see we've been on pretty consistent high prints here. Only the fourth time in the last 5 years we've seen this. Now, Jefferies U.S. economist Tom Simons made sense of this, saying contraction by technical speaking, because it was below 50, largely, again, he felt like pause was the key word. You're just seeing firms in the services sector saying, I want to wait and see. I want to see how all of this plays out. New orders came down, prices paid went up. A feeling of perhaps stasis in some of this May data right now.
So ADP below consensus, ISM Services below consensus. Any good news?
Yes.
In any of this data?
There was some good news, Josh. People are still making money. So what we're looking at here is wage growth for job changers, job stayers. Job changing means, of course, you go to a new job. Job staying would mean you stay at your job. We're well off the highs here that we saw in 2022 during that great resignation, right? But you're still looking at about 7% year-over-year wage growth for people that change their jobs and 4.5% for people that stay at their jobs. Richardson making the point this morning, again, that's ADP's chief economist, it hasn't moved that much. If wages were coming lower, that would start to be one of the key concerns, right? But they're not. They're sort of staying steady. And she said if you have steady wages, people aren't getting laid off, that gives the Fed maybe a little bit of room to say, okay, look at this data, let's wait and see, continue to do that wait and see to potentially cut rates. But right now it is a sign of some strength
Wages
in what is a cooling labor
yeah,
market.
Should be good for consumer spending.
Right, exactly, right? We need money to be able to go and spend.
Yep.
Takeaway number 2, Josh, it has been a week of S&P 500 target raises. This was the third raise that we've seen this week alone, this one coming from Barclays. Moving up to 6,050, which I should note, we're not that far from, right? So Venu Krishna over at Barclays not necessarily calling for the type of rally we're seeing from the team at Deutsche Bank. So I spoke with Krishna this afternoon. He said the key piece that he really saw driving up his target a little bit, not earnings, he kept his earnings estimate the same. He said with peak tariff uncertainty gone, he thinks the market can now trade at a little bit of a higher valuation. So that valuation goes up a little bit. These calls are often just simply price to earnings ratio times my earnings estimate, and then you get to 6,050 versus their prior call of 5,900.
And did he give you any kind of color under the hood what he likes, what he doesn't like.
You know what was interesting, Josh? He still likes big tech. And so he's been pretty big on big tech over the last 2 years at this point. And what Krishna told me, look at last earnings season, right? That's where a lot of the earnings growth was. It still came from that Mag 7 cohort. And he said Mag 7 still trading at a lower valuation than we saw pre-Liberation Day, pre-February, that sell-off. Maybe there's more room to run in the multiple for some of those big tech stocks, which have already been rallying a decent amount.
All right, thank you, Joshua. Appreciate it. Stick around. Much more Ask for a Trend. That's still to come. Well, the world's biggest music companies such as Universal, Warner, and Sony now looking for partnerships with major AI music firms that they aggressively sued just last year. For more on what the deals could mean for the music industry, let's welcome in here Seth Schachter, Strat America's founder and managing director and a former Sony music executive. Seth, it is great to see you on the show. So maybe start high level, Seth, because there is no trend that investors are more excited about than the mega trend and theme of AI. So I'm curious, Seth, to get your high level thoughts, how you see AI impacting the music industry moving forward. Positive, negative, too soon to say. And maybe start, Seth, with what it means for the big labels.
Yeah, sure. Great to be here, Josh. So, it's mixed. It's guardedly a positive thing, AI. In my view, it isn't something that is wildly destructive. It's not what some people would call like a Napster moment where, the industry is looking at it from the perspective of destruction and really declining. But I also just want to be, kind of guarded because I think it's a positive, constructive thing, but I don't think it will be a complete game changer for the recorded music industry. I think what's most important right now is that the industry, the rights holders, the labels and the publishers, need to set legal benchmarks so that the thing can kind of emerge, out of the muck, if you will, as a legitimate business. And I think that's what the gist of, it hasn't been officially reported. It's sort of been on some reports out there what the gist of this is all about. It looks like the three majors right now are looking to kind of do deals with, rather than sue out of existence, the two major AI platforms in the States, Suno and Udio. So it's guardedly positive.
And so if you were still at Sony, Seth, I'm curious what moves you would be making as you try to leverage and profit from AI. Would it be those kind of deals?
Yeah, and just to be clear, I don't speak for Sony anymore. I got a lot of good friends over there. But I think what I see with this right now, it takes me back to the time when YouTube was launching, actually, around 2007, 2008. And it kind of hit us as rights holders over the head, I think in a bigger way than this AI stuff is done, because we had tons and tons of artists and content that were being viewed and played all over the world, which, to be honest with you, weren't on our radar, weren't even in our active catalogs, and kind of hit us over the head like, oh my God, what's going on here? And I think the benefit of that time, maybe it's going to be like this now, I don't know, is that Google kind of came in and said, we're sorry, here's something for the past infringement, and then here's a big kind of advance, if you will, for the going forward usage of it as well, which will be legitimized. And, I don't know, don't have any inside information to be clear, but that would kind of be my bet as to kind of the top level as to what will go on. Subsequently, there'll be some commercial terms around it as well.
I'm curious, so that's the labels. What would be your advice to artists? And maybe start with, let's say you were a bigger, more established artist. What would you be telling them to do? Because some of them have been coming up with some interesting ideas. I remember Grimes, Seth, if I remember right, she had this idea, like maybe she was telling fans, okay, make music with AI versions of my voice, but then register on my site so we can sort of share in the royalties. What do you think of these different models the artists are experimenting with?
I think, anyone should be encouraging the artist to experiment with this stuff in a constructive way right now. And I think that's what actually Universal is doing. I think Sony's done a little bit of it as well, offered some platforms for the artist to experiment. Because personally, I don't see a mashup that you can create with voice of Tchaikovsky playing in the style of Miles Davis with a heavy metal band in it, is going to be taking over the charts. I think some of this is going to be incremental stuff. But I think the real thing going forward in music, Josh, is that the landscape has really changed. So artists have a lot more power now. They don't need labels, actually. And so they can go to their fans or their fan clubs and create lots of stuff, whether it's B-rolls, artist content, you name it, merchandise. And there's a real opportunity there. And I think some of this AI stuff could play into that. And so I think it's more about, trying to seed the market and making sure your rights are protected if you're a Universal or a Sony or Warner. But it's also about trying to create an ecosystem for artists so that they can kind of play with stuff and experiment. And so the kind of two streams going on, and it's pretty positive. I don't think anyone's going out of business from this specifically.
Last question, Seth. We talked about what this could mean for the labels, for the artists. I'm also curious how you think this ultimately plays out for Seth and Josh, for the consumers. What's this going to mean for us?
Well, it's a great thing. I think there is a larger strategy coming that Universal has publicly avowed. It's called Streaming 2.0, and it includes a lot of cool features: high fidelity audio, fan clubs, merch. It will include AI stuff, and I think you'll see it, as a premium tier within Spotify and perhaps other streamers, Deezer's, others that are out there, and you'll be able to play with this stuff, whether you're doing it or you'll do it. I think that's my hope, that it becomes kind of an incremental positive add-on to the ecosystem right now, as opposed to something that's a messy, destructive thing. But we're early. Copyright law, regulatory stuff isn't there. But I do think if these partnerships happen, it would be a very positive thing.
All right, big, complicated, but exciting topic. Seth, thanks so much for joining us today. Appreciate it.
Great to be here.
Stick around. Much more Asking for a Trend. That's still to come. For our chart of the day, we're taking a look at the labor force and how ADP and government job data are telling different stories about the job market. Yahoo Finance's Julie Hyman joining me now with a closer look. Julie.
There are various ways for economists to measure the job market, and the gold standard is really the data that comes from the government, from the Bureau of Labor Statistics that sits within the Labor Department. But we did get a piece of jobs data this morning that is from ADP, Automatic Data Processing, the big paycheck processing company. That's a number that the market watches as well. And we learned that 37,000 jobs had been added last month, according to the ADP. That was a big miss vis-a-vis what economists were expecting. And so we saw a negative market reaction initially. But if you talk to economists, guess what? They say that ADP number is not a very good predictor of the BLS number, and they really give it much less weight, if any weight at all. One way to measure this is captured in our chart of the day. We're looking here at ADP employment, which measures private sector employment, versus the government data just on the private sector. And this is ADP minus private non-farm payroll. So basically it looks at the gap between the two. So if ADP was a good predictor, you would see them always kind of very close to this zero line. And in fact, goes back to last month. We saw ADP overstate what the government showed, and we see sometimes it understates. So there's pretty big gaps here, which explains one of the reasons why economists don't pay that much attention. One of those we talked to earlier today, Carrie Freestone from RBC. Here's what she told us.
We don't give a ton of weight to ADP, and we don't think the Fed will either. There's been a significant divergence between how the ADP has performed and how the payroll numbers have performed in recent months, and the correlation has significantly weakened over the past 11 months. So we think the Fed is going to be most focused on the payrolls data that we get on Friday.
So if the Fed's most focused on Friday, then we are most focused on Friday, and we'll be watching that number very closely. Right now, economists on average looking for payroll gains, not just private, but overall, of 126,000. Josh?
Thank you, Julie. All right, let's take a look now what's trending after hours. Checking in on shares of MongoDB, Five Below, and PVH. Starting first with MongoDB, that company reporting an earnings beat for the first quarter. MongoDB also lifting its revenue and earnings outlook for the full year. Earnings guidance topping the street's expectations. Five Below announcing first quarter revenue that beat estimates, net sales rising 20% year over year. As for the full year, Five Below narrowing its earnings outlook, however, still falling short of expectations there. Five Below also announcing its CFO, Christy Chipman, is stepping down for personal reasons. PVH shares sliding here. That's following their quarterly results. Company's revenue increased by 1.6%, but missing estimates for the first quarter. PVH also slashing its earnings forecast for the full year, noting that its outlook reflects an estimated impact related to tariffs. Well, that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.